President Trump recently declared that a trade deal with China is done. It sounds like a definitive end, doesn't it?
On the surface, maybe. Like, okay, finish line crossed.
But when you actually look at all the articles, it tells a very different story. And that's our mission for this deep dive, to figure out what this announced deal actually means, in practical terms, for companies trying to navigate their supply chains right now.
Welcome to Logistics Pulse, sponsored by Mothership. Skip the broker to save big on LTL shipments, or deliver same day nationwide. For more insights like these, don't forget to subscribe to Logistics Pulse on YouTube, Spotify, or wherever you get your podcasts.
Because the headline might shout closure, but yeah, the reality for freight carriers, manufacturers, retailers, based on everything we're seeing, it's far from settled.
Let's unpack this. Let's start with the announcement itself. According to the sources, what specific details did this deal is done declaration actually confirm?
Well, what U.S. Commerce Secretary Howard Lutnick confirmed is that the cumulative 55% tariff rate on most Chinese imports, that's now established as the new baseline.
Okay, a baseline.
Right. And critically, no additional tariff increases are planned under this framework. But, and this is just as important, no reductions are happening either. That 55% stack is essentially locked in.
Locked in. And the sources immediately point out something fascinating. While the U.S. announced this specific 55% baseline as done, Beijing hasn't publicly confirmed those exact details. They've only referenced an earlier Geneva consensus. What does that difference signal?
Yeah, that lack of sort of reciprocal confirmation from China, that's a major point of uncertainty. The sources suggest the Geneva consensus Beijing refers to as maybe more of a preliminary understanding or like a broad framework.
Not a detailed agreement on specific rates like 55%. So you'd think a deal might spark some optimism, maybe a boost in activity. But the sources indicate the reaction from supply chain leaders has been much more measured, cautious even. Why so subdued?
Because the reality for freight movers and retailers hasn't fundamentally changed overnight. It's not like a switch flipped.
Right.
Less is a moment of celebration and more one requiring revised forecasts, continued cautious spending.
And sticking with diversification.
And definitely an accelerated push to diversify sourcing away from China, which, was a trend already well underway. This just adds more fuel to it.
And the actual movement of goods. Orders are reportedly still running, well below 2023 levels. That seems counterintuitive if a deal is supposedly done.
It does, but the sources explain that part of the reason is that shippers already pulled a significant amount of freight forward earlier in the year.
Oh.
They were trying to get ahead of the potential tariff increases that were being talked about back then. So some of that volume people might have expected now has, already moved through the system.
Speaking of movement, rising port congestion. But it's not the kind of congestion you'd expect from, say, an import surge spurred by a deal. What's actually causing it?
Yeah, that's where the granular detail really matters. The congestion isn't from a flood of inbound goods. It's largely from an excess of empty containers.
Empties.
Yeah, empty boxes that ocean carriers are struggling to reposition effectively. With reduced sailings and shifts in trade lanes, getting those empty containers back where they're needed. That's the current logistical headache.
Interesting. So how are retailers handling their upcoming peak season freight in this slightly weird environment?
They're definitely moving holiday goods in, like tighter volumes, and with more selective SKU strategies.
Being careful about what they bring in.
Very disciplined, probably hedging against uncertain consumer demand and also, the higher costs that are now locked in by these tariffs.
Things like truckload and intermodal volumes reportedly down double digits year over year. What does that tell us?
It points to a broader softening, doesn't it? In the economy and supply chains within the U.S., it's not just about China imports at this point.
And then you add the wider economic context. Jamie Dimon's warning about a potential macro slowdown, suggesting real numbers will likely deteriorate soon. It feels like this isn't just about tariffs anymore.
While the threat of further tariff hikes might be off the table for now, you've still got this complex interplay of uneven consumer demand, high operating costs, these lingering logistical disruptions. It means the operating environment is still incredibly challenging.
This announced deal fundamentally doesn't fix for businesses. What are the key concerns that are still just there?
Well, the most significant one, as we talked about, is that the 55% baseline tariff rate for Chinese imports, it remains firmly in place. That's a permanent, non-reducible cost layer under this done deal framework as it's presented.
Right, a major cost that isn't going away. And the fact that Beijing hasn't publicly confirmed the deal details as the U.S. has That leaves a pretty big question mark, doesn't it?
That crucial bilateral agreement piece is still, well, missing in the public sphere.
Hmm.
There's also no clear mechanism outlined in any of the sources for how future adjustments to these tariffs might even be made. Nor is there any timeline for a broader rollback of tariffs or, re-engagement with institutions like the WTO, more as a holding pattern than a clear path back to, say, pre-tariff trade relations.
So companies have to plan and operate within this new, more expensive constraint.
Exactly. All while knowing the political landscape, especially with the election cycle heating up, could shift things yet again. The ground isn't exactly stable.
Okay, so given this really complex picture, a deal that leaves major questions unanswered and operational challenges very real, how do you navigate this?
4 key areas where businesses really need to concentrate their efforts and planning in the coming months.
Okay, what's the first one?
The first is leveraging any remaining tariff pause window. They note the 90-day tariff pause that began back in the spring. That's set to expire in mid-August.
Mid-August, okay.
Right. So this means if you're still importing goods from China, you probably need to finalize those ocean freight orders pretty soon, like by the end of June.
To get them landed before the deadline.
Yeah, that gives you a better chance for them to arrive by mid-August and potentially avoid any confusion or, complications around that expiration date.
And they also emphasize looping in your last mile carriers early for those inbound shipments, right?
Yeah.
Especially if you rely on intermodal or local LTL.
Absolutely. Using a service like Mothership for same-day pallet delivery as one strategy. The idea is to bypass potential warehouse congestion and just generally stay ahead of what might still be a challenging peak season, regardless of the headline deal.
Makes sense. What's the second area?
The second area is preparing for these persistent port and container imbalances. We touched on this. While ports like LA and Long Beach are starting to recover from earlier surges, this issue isn't fully resolved.
Empty container problem.
The empty container problem. Too many empties, carriers struggling to reposition them effectively because they've reduced overall sailings.
So even as imports aren't surging like crazy, businesses should still anticipate challenges getting and returning containers.
Absolutely. The expectation should be for potentially longer lead times on getting containers, stricter policies perhaps for returning empties, and maybe higher inland container rates. Particularly, the sources note, at ports like NYNJ and Houston, which have actually seen rising volumes.
Okay, so watch the container situation closely. What's number 3?
The third focus area is watching for those continued sourcing shifts, that whole China plus one trend. The specific data here really illustrate this point.
Oh, yeah.
They show U.S. container volumes year over year are down from traditional places like China, down 11%, South Korea, down 9%, and even Italy, down 15%.
Okay.
But significantly, volumes are up from places like Vietnam, up 21%, and India, up 13%.
Wow, those are pretty big swings. That data isn't just numbers. It really shows how shippers are actively moving production, moving sourcing to new geographies, looking for stability maybe, less political risk.
Seems likely. And the sources stress that if your freight is suddenly arriving through different ports or different cities because of these sourcing shifts,
You have to rethink your domestic route.
you absolutely must reassess your last mile routing strategy. Your old domestic network might not be the most efficient or cost-effective anymore. Makes sense, right?
Total sense.
Okay.
Okay, and the final piece of advice.
Finally, planning inventory with discipline. Real discipline. They cite a National Retail Federation projection forecasting a 14% decline in freight volume from June to October compared to last year's holiday season run-up.
14% down. Why so cautious?
Well, it reflects several factors. Those earlier front-loaded orders we talked about stealing some volume from now,
Right.
more cautious consumer demand forecasts from retailers just generally, and companies intentionally reducing inventory risk, trying not to get stuck with too much high-cost inventory bought under that 55% tariff regime.
So if you're bringing in less volume overall, you have to be incredibly strategic about what you bring in.
Carefully balancing that reduced inbound volume with the absolute need to maintain fulfillment speed. Customers still expect things fast.
It means really evaluating which shipments are, margin accretive under the current tariff situation.
Right, which ones actually make money versus those that might need consolidation or maybe alternative routing just to make economic sense anymore. It requires a really sharp pencil.
This detailed picture shows how these big, complex, global announcements don't just live in headlines.
Yeah, at all.
They cascade down and directly impact the day-to-day movement of goods, the strategies businesses have to adopt.
And the final clear takeaway seems to be this. For companies that rely on the consistent, efficient movement of goods, the single most critical factor, it isn't just managing tariffs anymore. It is agility.
Agility. The successful operators in this environment are described as the ones who can stay flexible, who can make decisions based on real-time data from the ground.
Not just assumptions.
And perhaps most importantly, who can move fast when conditions inevitably change again, because they probably will.
For more insights like these, don't forget to subscribe to Logistics Pulse on YouTube, Spotify, or wherever you get your podcasts.